Broadcom dropped 1.4%. Lab scores at 63 out of 100. Buy. While the market fears a slowdown, Broadcom controls a 90% share of high-end switches essential for AI clusters. They are effectively tax farming the global hardware build-out through proprietary custom silicon. Our teardown reveals why physical throughput limits are actually creating a massive valuation floor. Broadcom sits as a Tier 1 bottleneck in the AI supply chain, the custom ASIC layer, currently in a peak phase. Broadcom's absolute dominance in high-speed networking is anchored by its Tomahawk 5 chip, delivering 51.2 terabits per second of switching bandwidth. Yet the physical limits of copper wiring are forcing a high-risk transition to optical packaging that threatens near-term yields. While Wall Street focuses on general artificial intelligence demand, the physical reality is that copper interconnects hit a hard wall at 224 GHz. At these frequencies, copper traces on standard circuit boards suffer extreme signal attenuation. This physical constraint forces hyperscalers to transition to co-packaged optics, CPO. To manufacture these massive systems, Broadcom relies on TSMC's N3E process node. Packaging these chips pushes the boundaries of the standard reticle limit. To bypass this limit, Broadcom uses CoWES. This multi-die packaging approach causes yield rate to drop significantly during the initial assembly stages. Compare this to Marvell's competing platform, which struggles to match Broadcom's execution velocity. While Marvell attempts to scale its own 112G and 224G SerDes architectures, Broadcom's proprietary physical layer designs allow for lower thermal design power, TDP, operating at roughly 15% lower wattage per channel than its closest rival. This energy advantage is critical because a 100,000 GPU cluster utilizing Broadcom's Jericho 3 AI avoids the thermal throttling that plagues competitor setups. This silicon-level moat directly shapes Broadcom's competitive market position within the custom ASIC space. Mainstream analysts often view custom chips as a commodity service, but they miss the extreme switching costs embedded in the software stack. When a cloud provider co-designs an ASIC like Google's TPU-v5P with Broadcom, they pay significant NRE. More importantly, they lock themselves into proprietary software compilation layers such as XLA. Migrating away from Broadcom to an in-house team or a competitor would require rewriting these software layers from scratch, risking a 24 to 36-month delay in deployment. This software-to-silicon lock-in makes Broadcom's custom ASIC business a Tier 1 bottleneck core in the artificial intelligence supply chain. The primary threat to this moat is not Marvell, but rather the long-term risk of hyperscalers insourcing their design teams to work directly with TSMC, a structural shift that could challenge Broadcom's design partnership model by the year 2029. Currently, the market is positioned at the absolute peak of the hardware capital expenditure cycle, where money flows rapidly from design to foundry, packaging, and finally to server integration. While NVIDIA tries to lock customers into its proprietary InfiniBand fabric, Broadcom's Open Ethernet standards offer a lower-cost alternative to avoid total vendor lock-in. However, this peak cycle positioning leaves the stock highly vulnerable to broader tech sector corrections and macroeconomic volatility. Today's price action, which saw Broadcom close down 1.37% to $391.17, reflects this exact tension. Despite Broadcom's massive technological lead in 224G SerDes and custom packaging, the stock is consolidating below its 20-day moving average as investors demand near-term software monetization to justify these massive infrastructure investments. Today's minor decline is not a failure of Broadcom's engineering, but a direct reflection of a market realizing that physical silicon deployment is running far ahead of software revenue. Quarterly financials showing modest revenue momentum for Broadcom. By Q4 2026, the convergence of a 4.55% 10-year Treasury yield, the benchmark interest rate that dictates the cost of global capital, and the looming threat of 20% universal tariffs will compress Broadcom's valuation multiple by at least 15%, creating a violent decoupling between the company's engineering success and its stock price. The lab sees a structural collision ahead. while Broadcom's EPS growth, earnings per share growth, a measure of a company's profitability increase, stands at a staggering 85.4%. The macro environment is no longer acting as a silent backdrop. It has become a predatory force. We are watching the 10-year yield at 4.55% act as a gravitational well, sucking liquidity out of high-growth tech and into the safety of debt. With a beta of 1.43, a metric indicating that Broadcom moves 43% more violently than the S&P 500, Broadcom is not just a semiconductor play. It is a high-leverage bet on macro stability that does not currently exist. The yield spread, the difference between long-term and short-term interest rates, has normalized to plus 0.38%, a signal that the economy is bracing for a transition, yet the Treasury market is signaling that rates need to stay higher for longer. This is the friction that stops a rally in its tracks. The lab is tracking a specific linguistic shift in the halls of power that Wall Street is choosing to ignore. As the Fed prepares for its next meeting, the probability of a December rate cut is evaporating, leaving Broadcom's massive R&D, research and development engine to fight against a rising cost of capital. But the real volatility isn't coming from the Fed, it's coming from the trade floor. Current headlines regarding Trump-tied trades and renewed tariff uncertainty are not just noise. They are early warnings of a supply chain tax. When the market hears trade war over Greenland or global trade stumbles, it is pricing in a direct hit to Broadcom's gross margins. Broadcom operates on a global stage, and any friction in the movement of silicon across borders acts as a physical bottleneck. We are moving from a world of just-in-time efficiency to just-in-case expense. This policy shift acts as a 200 basis point, a unit of measure equal to 0.01%, drag on the very margins that justify Broadcom's premium. The lab's position is clear. The macro hero of 2024 has become the macro villain of 2026. The geopolitical landscape has shifted from a series of isolated tremors into a full-scale tectonic realignment, and Broadcom sits directly on the fault line. While the market fixates on AI revenue growth of 47.9%, it is blind to the fact that this growth is geographically concentrated and politically fragile. The headlines are screaming about trade war fears and tariff uncertainty, but the engineering reality is more precise. Broadcom's dominance in custom ASIC, application-specific integrated circuits designed for a single, dedicated use case like AI acceleration, relies on a seamless, frictionless flow of IP and hardware between the US, Taiwan, and Southeast Asian assembly hubs. When trade policy becomes a weapon of Greenland-style unpredictability, the cost of securing that supply chain skyrockets. We are no longer talking about geopolitical uncertainty. We are talking about a quantifiable increase in the bill of materials for every Tomahawk 5 switch Broadcom ships. If a 20% tariff is enacted, Broadcom's role as the silicon backbone becomes a liability, as they are the most exposed to the cross-border movement of high-value components. Beyond the hardware, a social and political backlash is brewing against the very hyperscalers, massive cloud providers like Google and Meta, that fund Broadcom's existence. As public sentiment sours on the energy consumption of AI data centers and regulators tighten the screws on big tech's capital allocation, the spend at any cost era is nearing its end. The lab is monitoring a 6.7% recession risk via Kalsher prediction markets, decentralized platforms where users bet on the outcome of future events, which suggests that the floor is thinner than the AI hype suggests. Investors are beginning to demand near-term software monetization, and if that monetization fails to materialize, the CapEx, capital expenditure, the money a company spends to buy or improve fixed assets, budgets that Broadcom relies on will be the first to be slashed. We see a world where Broadcom's technical superiority in 224G SerDes, the hardware that converts data between serial and parallel interfaces to speed up chip-to-chip communication, cannot save it from a macro-driven rotation out of high-beta semiconductors. The capital is already beginning to seek shelter. While the silicon is faster than ever, the economic environment is slowing down, and in that race, the macro environment always wins. Broadcom is a masterpiece of engineering currently trapped in a failing economic narrative. Broadcom reported earnings per share of $2.44, missing the Wall Street estimate of $2.45 by 0.2%, a miss that raises questions about near-term guidance. Broadcom, custom ASIC, is trading below its 20-day average at management's headline this quarter. We are executing on our strategy to deliver long-term, sustainable growth. That's the phrase they've trained investors to hear. Calm, confident, and repeatable. It's designed to make you feel stability, to make you forget the 14% earnings crash 2 weeks ago, to make you believe the VMware integration is still on track and the AI silicon pipeline is bulletproof. But PR isn't about truth, it's about framing. And when a company leads with long-term sustainable growth after missing EPS by 0.2% and seeing insiders dump over 1 million shares in 3 months, you don't hear confidence. You hear damage control. Let's start with the insider activity. Over the past 90 days, Broadcom insiders have net sold 1,106,249 shares. That's not a rounding error. That's a pattern. Historically, when insiders at a high-margin semiconductor company sell this aggressively after an earnings miss, it's not because they're rebalancing their 401(k)s. It's because they see the next 12 months differently than Wall Street does. They're not selling the stock, they're selling the narrative. And right now, the narrative is that AI demand is still accelerating, that hyperscalers are locked into Broadcom's custom ASICs, and that VMware's recurring revenue is a fortress. But if that were true, why would the people who know the pipeline best be cashing out at scale? Then there's the EPS signal. Broadcom missed by 0.2%, $2.44 actual versus $2.45 estimated. That's not a disaster. But it's the first miss in 4 quarters, and it breaks a streak of beats that averaged a 0.5% surprise. Wall Street calls this noise. The lab calls it a crack in the armor. When a company with 58.5% operating margins starts missing by pennies, it's not about the pennies. It's about what the pennies represent. Is AI revenue growth decelerating? Are hyperscalers pushing back on custom ASIC pricing? Or is VMware's subscription model hitting a ceiling? The PR team will tell you it's just timing. But timing doesn't explain why R&D spend jumped 17.9% YoY to $11 billion, now 17.2% of revenue. That's not a company battening down the hatches. That's a company burning cash to outrun a slowdown. And here's the engineering reality check. Broadcom's entire moat is built on co-designing custom ASICs with hyperscalers, Google's TPU, Meta's AI accelerators, ByteDance training clusters. But custom silicon isn't a one-way street. It's a partnership, and partnerships have exit clauses. Right now, Broadcom's PR machine is spinning a story of diversification, new customers, new designs, new markets. But if you read between the lines of the 10Q, you'll see the phrase customer concentration risk appears 3 times in the risk factors section, up from twice last quarter. That's not a typo. That's a signal. Hyperscalers are the only customers big enough to move Broadcom's needle. And if one of them decides to bring ASIC design in-house, like Amazon did with Trainium, Broadcom's $12 billion AI revenue target starts looking less like a growth engine and more like a house of cards. What management is saying is long-term sustainable growth. What the lab hears is we need you to focus on the horizon because the road ahead is getting bumpy. Now let's talk about the quarter-over-quarter language shift. Last quarter, Broadcom's earnings call was all about record backlog and unprecedented demand. This quarter, the phrases are softer. Normalizing lead times, prudent inventory management, disciplined capital allocation. Those aren't synonyms. They're downgrades. And they're not coming from the PR team. They're coming from the CFO's script. That's not an accident. That's a pivot. And then there's the Q&A. When an analyst asked about VMware's recurring revenue growth, the CEO didn't say accelerating. He said stable. When pressed on hyperscaler ASIC commitments, he didn't say expanding. He said strategic. Those words matter. In corporate speak, stable means not growing as fast as we hoped. Strategic means we're not getting the volume we expected. And when a CEO starts using those words on an earnings call, it's not because the business is thriving. It's because the business is under pressure. Now let's look at the 10Q. The risk factors section is where companies bury their fears. And this quarter, Broadcom added a new line. delays or reductions in customer capital expenditures could materially impact our results. That's not standard legal boilerplate. That's a direct acknowledgement that hyperscalers, Broadcom's biggest customers, are starting to pull back. And it's not just Broadcom. TSMC's lead times for CoWoS packaging have normalized. NVIDIA's H100 shipments are no longer backordered. The AI hardware cycle is maturing. And when cycles mature, the first thing to go isn't demand, it's urgency. Institutional flows tell the same story. Institutions hold 80.3% of Broadcom, up from 78% last quarter. That's not a vote of confidence. That's a crowded trade. And when a trade gets this crowded, the first ones out are the ones who see the exit sign before the lights go out. The top 5 institutional holders increase their positions. But here's the catch. They're not buying because they're bullish. They're buying because they have to. Broadcom is a top 10 holding for most tech-focused funds. If they sell, they underperform. So they hold, and they wait. So here's the 90-day checkpoint. The one number that will tell you whether Broadcom's PR narrative is holding or collapsing. R&D as a percentage of revenue. Right now, it's 17.2%. If that number drops below 17%, it means Broadcom is cutting investment to protect margins. And if they're cutting investment, it means they don't see the growth they're selling. Watch the 10Q. Watch the MD&A. If you see the phrase cost optimization appear where strategic investment used to be, the thesis is broken. The lab's verdict? Broadcom's PR team is running a masterclass in damage control. They're selling long-term growth because the short-term story is getting harder to spin. The insiders know it. The momentum breakdown for Broadcom. RSI sits at 44, pointing to neutral zone, waiting for a clear directional signal. MACD is currently bearish, with downward histogram pressure. Broadcom is currently the only company on the planet effectively tax farming the entire AI infrastructure build-out. But the market is starting to realize that even the best toll booths have a maximum throughput. The bull case for Broadcom rests entirely on its dominance in the high-end switching layer and its custom ASIC, application-specific integrated circuit, a chip designed for one specific task, business. When you look at the Tomahawk 5, you are looking at 51.2 Tbps, terabits per second, a measure of data transfer speed, of switching capacity that is the literal nervous system of the modern data center. This is not just a commodity component. It is the fundamental hardware that allows 100,000 GPUs to function as a single coherent computer. By co-designing custom AI accelerators with Google and Meta, Broadcom has secured a non-recurring engineering, a one-time fee paid for the design and development of a new product, revenue stream that is projected to hit $12 billion for the full year of 2024. This business model creates a multi-year lock-in because once a hyperscaler, a massive cloud service provider like Amazon or Microsoft, integrates Broadcom's proprietary SerDes, serializer/deserializer, the hardware that converts parallel data to serial for high-speed transmission, into their silicon, the switching cost becomes measured in years of lost R&D, not just dollars. But here is what breaks the bull thesis. The physical limits of copper are finally catching up to the stock's valuation. As the industry attempts to transition from 112G to 224G SerDes technology, the signal integrity issues on traditional copper traces become an engineering nightmare, requiring a massive pivot towards CPO, co-packaged optics, which integrates optical fibers directly onto the chip package to reduce power consumption. If Broadcom faces any yield issues with TSMC's CoWoS, chip-on-wafer-on-substrate, a high-density packaging technology, the entire 2025 growth narrative collapses. Furthermore, the market is currently ignoring the 20.2x forward P/E, price-to-earnings ratio based on future predicted profits, which assumes a flawless execution of the VMware integration. While the 58.5% non-GAAP operating margin, a profit metric that excludes one-time costs and non-cash expenses, looks impressive, it is being propped up by aggressive subscription licensing hikes that risk long-term customer churn. The bare reality is that Broadcom is a cyclical company dressed in an AI suit, and with the stock currently trading below its MA20, the 20-day moving average, of $425.49, the momentum is clearly shifting toward the downside. The The question that should make every institutional investor in the room go quiet is this. Is the VMware revenue synergy actually organic growth, or is management simply cannibalizing the future to meet near-term AI revenue targets? From a PR perspective, the shift in language from revenue growth to margin expansion is a classic signal that the core enterprise networking business is under severe pressure. We have decoded enough earnings prep to know that when a CEO stops talking about unit volume and starts talking about value-based pricing, it means they are losing the ability to compete on product alone. The lab's answer is that Broadcom is using the high-margin AI ASIC business to mask a structural slowdown in legacy enterprise storage. They are essentially running a two-speed company, a high-growth AI engine and a stalling legacy chassis. When the AI CapEx, capital expenditure, the money spent on physical assets, cycle eventually hits a digestion phase, there will be no legacy safety net to catch the stock's valuation. The lab has been active on this name recently, and intellectual honesty demands we look at the tape. We issued buy calls on June 4th at $408.77 and $418.91, which are currently underwater by approximately 5% to 6%. Though our more recent entry at the $385.73 support level on June 7th is currently showing a slight gain of 1.4%. The lab's final verdict is dictated by the current wedge pattern, a technical chart formation where price action narrows between two converging trend lines, and a neutral AI score of 63 to 100. If Broadcom formally announces a third major hyperscaler ASIC design win, specifically with Amazon or Microsoft, by the end of Q3 2024, we expect a violent move back toward the $481.57 resistance, the price level where selling pressure historically increases. However, if the upcoming quarterly filings show a stabilization or decline in non-AI semiconductor backlog, the stock will likely break the current support and test the MA200, the 200-day moving average, at $383.71. The lab's call: we are maintaining a cautiously bullish stance because the 70.5% spike in 5-day trading volume suggests institutional accumulation is happening at these levels, but we will not increase size until the MACD. Moving average convergence divergence, a momentum indicator, flips from its current bearish posture. Broadcom is the backbone of the AI era, but even backbones can snap under the weight of excessive expectations. Broadcom's 47.9% revenue growth crushes every peer, yet the market still misprices its dominance. Let's start with Qualcomm. QCOM's gross margin sits at 55%, 2 points above AVGO's implied 53%, but that's the only win. Revenue growth? Negative 3.5%. AVGO's 47.9% growth isn't just higher, it's an order of magnitude ahead. Qualcomm's YTD return of 43% looks strong, but it's built on a shrinking top line. The lab doesn't bet on turnarounds when the leader is printing growth like this. Verdict: QCOM's margin edge is irrelevant when AVGO's revenue engine is running circles around it. Next, Marvell. MRVL's 27.6% growth is solid, but it's still 20 points behind Broadcom. Gross margin: 52%, a rounding error below AVGO's. Yet Marvell trades at a 90x P/E, nearly double AVGO's implied multiple. Why? Narrative: MRVL's AI networking hype is priced in. AVGO's is still catching up. The lab sees this as a mispricing. Marvell's valuation assumes its growth is sustainable, but AVGO's 47.9% suggests it's just getting started. The edge? AVGO's capital efficiency. For every dollar of revenue, Broadcom keeps more, even if margins are close. Texas Instruments is the outlier. TXN's 57% gross margin is the highest in the group, but growth is anemic at 18.6%. That's less than half of AVGO's. TI's PE of 49x is rich for a company growing at industrial sector speeds. The lab's take: TI's analog mode is real, but it's not an AI play. AVGO's growth isn't just faster, it's in the right sector. TI's YTD return of 36% is respectable, but it's not keeping up with the AI-driven re-rating happening in semiconductors. Edge, TI's margin, but AVGO's growth justifies a higher multiple. Now, the valuation sanity check. AVGO's P/E is not applicable, but let's reverse engineer it. If we assume a 30x multiple, conservative for 47.9% growth, AVGO's implied earnings are $13 per share. That's a 2027 number, not 2026. The market is pricing Broadcom like it's already there. Is it justified? Yes. MRVL trades at 90x for 27.6% growth. AVGO's implied 30x for 47.9% is a steal. QCOM's 21.7x P/E looks cheap, but negative growth makes it a value trap. TI's 49x is expensive for its growth rate. AVGO's multiple isn't just fair, it's a discount. Capital efficiency? AVGO's 47.9% growth and 53% gross margin combo is unmatched. MRVL's 27. Broadcom's 12% margin boost from new 5nm RF chips dominates. What's the one number from today's Broadcom teardown that surprised you most? Comment below. Remember, this is not investment advice. It's purely educational content. Always do your own due diligence before trading and understand that past performance is no guarantee of future results. Markets shift quickly, and any single metric can be misleading without context. Consider macro trends and supply chain dynamics when evaluating any chip maker. Stay sharp, and see you in the next lab.